All right, everybody. My name is Charles, and we're going to talk about renewable energy today. So, what are they up to? Well, I'm going to let you guys read those words while I tell you about the shapes here that matter. So the triangles represent where they have a plant. So they have a refinery, and they have their production facilities are the triangles. So as you can see, they're mostly clustered around their headquarters in Iowa, and then over in the Midwest generally. There are some down in Houston and also in New Orleans, and then up here in Grays Harbor, Washington, a little bit outside Seattle. The blue circles are where they have biodiesel terminals, so that's directly where you can load it on a train, truck, or in some cases pipeline. Not many pipelines though. And then the orange circles are blended diesel, and then the green circles are just regular petroleum. We don't do a whole lot of that, but it's not really their thing. But they do have access to them. That's really cool, you say to yourself. But how much money did they make? A good bit. So for those of you who went on the Juneau trip, PFD people said that they paid their $4.5 million in about half an hour. So these guys would have to work there for a few days, probably. But their biodiesel accounts for almost 80% of total revenue, 78.8. Government incentives, things like tax credits, specifically the biodiesel tax credit, account for 15%. There are also several states that offer tax credits, so you don't either have to pay sales tax or you pay lower sales tax per gallon of diesel that you sell. And then RINs, which is the Renewable Identification Number. It's essentially how carbon tax credits work. So if one company produces a gallon of renewable fuel, it comes with a tracking number, and you can sell that to a different company so that they meet the EPA specifications for how much biodiesel and renewable fuels must be consumed in a year.
And that's U.S.?
Yes, this is it's all from the U.S. Their external sales are all from biodiesel. How do they make all that? Well, they sell diesel on the open market to buyers, and so the EPA mandated, starting in 2012, that there was going to be a limit on how much, as a minimum, renewable fuels must be sold for diesel products. So it's currently 2.1 billion. That's also what it was last year. It has gone up every year since 2016. Other than that, though, it was something like 1.29 billion in 2016, and then 1.5, and then what's it, 2.1? And that 4.29 billion gallons must be advanced biofuel. So all of their products meet both of those standards, but not everybody makes biodiesel. So advanced biofuels, things like corn ethanol, or if you're using vegetable oil from soybeans, or other products. So, and then government incentives, so things like tax credits and production incentives to keep America going forward on a path to using cleaner fuel and in compliance with Paris Accords. So their fuels will reduce the greenhouse gas emissions of diesel engines by 60% on average. They have some that can do higher, but with most of their production facilities being located further north, you don't get the full benefit of it if it's cold, so they have to blend it a little bit more with petroleum. And so on average, they get about a 60% reduction in greenhouse gases. And then by selling RINs, which, as I said, are essentially carbon credits for the renewable fuel industry. Where's the money come from? It comes from America. Blue is the U.S., which accounts for 92% of their revenue. Germany accounts for just about 8%. So they finalized the acquisition in 2017 of 2 German refineries. And the revenue, I could not give you a per plant basis, they do not report it that way. But some of the major contributors to that are their Geismar facility that's down outside New Orleans in Louisiana. It was this little triangle here. and their Madison plant, and that's in Wisconsin. So those two are big producers. Okay. Why these guys? Surely there are other larger companies doing that. That is correct, but they have invested through their life science division in the ability to use lower grade feedstocks, so they can use things like cooking oil, animal fats, they're almost direct from the slaughterhouse, and used greases. So most other companies use corn, they use soybeans, they use canola oil. Those are all higher price. So with Renewable coming in at the bottom of the market almost as a discount player in terms of the gasoline that they can offer, I feel that they are a more attractive proposition than their competitors. Yes?
Do they have any pure play competitors? It's a little bit cut off, but I'm just trying to look at the comps you chose, and I see some of them are diversified energy companies. I can't tell
They are. So the comparable companies I selected, Bloomberg gives out a very nice breakdown of how much revenue was delivered from the renewable fuel sector, and those were the companies that had roughly the same profit from, or revenue rather, from renewable fuels.
So are any of these pure play, or are they all diversified?
Neste is almost a pure play. They are a Finnish company. They have holdings in Finland and Singapore, and they are almost as pure towards the biodiesels and renewables as
But I imagine they don't operate in the US market?
They are an ADR, but they do not have any production facilities here. They sell here. And we're going to talk about, I believe, Singaporean companies is on here, something about them. And then Green Plains is another one that is heavily towards that. If you look at the available production capacity, you see that Green Plains is massive. They're almost double size. Most of what they make is ethanol for other industrial uses, though. So they're not using it per se as fuel, but they could if they decided to switch there if the conditions became right economically. So, working harder, hardly working. Yes, they don't have the best numbers, but their revenues have consistently increased, and their net profits have been going up. They have gone up more than they went down last year. I personally, having looked at the company, believe that the time of negative net profits is over, and that they're having placed significant investment into their production facilities over the last couple of years, will be able to continue driving the revenue higher and also the net profits higher with it. So they will not have some negatives. There were some plant accidents, several fires in 2015 and I believe 16. We discuss yes. So in 2015, their Geismar plant, which accounts for roughly 15% of their product, was closed. It was closed about half the year. It had a fire in April, and they were able to get it started back up, and that had another one in September. And then in 2017, plant in Madison, we also talked about, was about 5% of the revenue. Had some issues and it was offline for about half a year, but they're both back up and producing now.
So what are they doing to improve fire safety? Could you also show us the map of how many facilities they have? Like, because if one goes offline, like how many other facilities are there?
They have 14 facilities all told.
Okay. 14 facilities.
It's pretty common for them, their reactions and such.
No, it is just something that does occasionally happen though. They have not had any other accidents besides those at any of their other facilities. But since we had talked about those previously, and they do contribute significantly to the amount of product, I thought that would be cogent to mention. And I believe that that is largely why net profit went down. It is hard to make money when you're a producer and not producing. And so take a look at their long-term debt and their current liabilities. as we see, they're almost equal, but they're less, and then there's a massive reversal. The company has two sets of long-term notes, and they came due in 2019, which they paid most of them off in 2018 and 2017. 2018 date is not enough yet, it'll be out very soon. But they wanted to pay those off before they came due, and so there was a $75 million repurchase program authorized in 2017, and they spent that very wisely. They have compensated for that by taking on more short-term debt, and so causing the current liabilities to increase. It's almost all short-term debt that is increasing on the liability side there.
So I want to look, I haven't looked at, let me flip the page or see what you have in there. So if they're now eschewing long-term debt in favor of taking on more short-term debt, I'd be interested in their credit score. Why is that, or their credit rating? Why is this a move that they're making? Because it's sometimes, especially in an industry where clearly you have to invest in these plants and have some like long-term assets, you try to have like a match between the life of and the duration of your assets and your liabilities. So why are they moving towards shorter term debt?
I believe that is so that they will remain available to have more long-term debt. They have 3 plants in construction right now, and they're trying to just get them finished, but they don't want to take on more. They depreciate their assets on a straight line basis, and their plants are depreciated over the course of 30 years. So the notes that they have now, being 17 years until maturity, will cover about half of the time, assuming that those plants are finished in the near future. They're all about 50 to 60% complete.
Near future, like 3 years, 10 years?
3 to 4 years. They said very short term, they didn't expect it to be done, but given the amount of progress that they have on it, 3 to 4 years is reasonable. So, in summation, they've had some troubled times, but they came out the other side without going bankrupt, which is always good. They have excellent growth prospects. They are the largest producer in America of these fuels. And there's no sign when I was looking at the comparables that any of the other major players, Valero is on there, that's a company on hold. There's no sign that they're starting to shift to this in any major amounts. And they have very little debt over a year. That would cause them to have slow growth, so they can take out more notes, but right now they're able to meet all their needs quite well. Their current ratio is noted, and it is 1.58.
So they're selling these biodiesel fuels primarily in the US.
Yes.
And you mentioned they do have some overseas competition that maybe doesn't refine in the US, but
Yes.
sells in the US?
Yes, specifically the Argentinian and yes, Indonesia. And so I was not able to find if that Indonesian plant was owned by Nesti, the Finnish company, but they do have holdings in Indonesia.
I'd be curious about that just because transporting fuel is expensive.
It is, and so there is actually pending litigation against several of those companies for dumping. The National Biofuels Coalition accused several of these companies specifically of dumping, and there have been fines levied against them by International Trade Commission. So they're ranging from 60 to 267% depending on the company. There is also a countervailing duties case before the International Trade Commission. The U.S. Department of Commerce has already said that yes, these countervailing duties should be set, but we're waiting on the final decision from the International Trade Commission. It should be coming out this month or perhaps next month, and it's going to set them at 34 to 72% between the countries of Argentina and Indonesia.
My big concern is basically what what gives this company an edge and what keeps it, like keeps competitors out of the market, so kind of barriers to entry. So I'd imagine transportation costs, or you're talking about some tariffs, are one
Yes.
way that it would keep competitors out of the market, but maybe you could put some thoughts around that, maybe make a slide or something to follow up after spring break on that particular issue. Well, basically, what gives this company an edge and keeps competitors out of the market? The second piece I'd be concerned with, and I see you have kind of a long description here under investment risks, like EPA, kind of incentives to use biofuels.
Yes.
How much discretion does the EPA have in setting those? Are they like
They're the ones who set
codified
it.
into law, or is this something that's a regulatory requirement that can change at any given moment, or?
The way I read it is the requirement to have a set number is statutory, and so that's set by Congress, but the EPA gets regulatory discretion as to what to set it at.
Okay, and the other two pieces, like the RINs and that portion of the business, how much discretion is there? Because a lot of this is kind of dependent upon government, there's government incentives
Right.
and RINs, those are both quite dependent upon like regulation. and
Generally
that.
produce 1.5 to 1.7 RINs per gallon of biodiesel that they make, and so they're able to take, if they make 2 gallons, then they can sell 3 RINs. But it changes depending on exactly how renewable your fuel is, so you can get up to, I believe, 3.5 if your fuel is extremely good at
Guess my
cutting
bigger
carbon emissions.
concern there is just, is there any risk that EPA, changes in EPA regulation might change the way that program functions?
Not those programs so much. There has been some similarity to that with the biodiesel tax credit. That was on the books and it expired in 2016, 40 or 2017. And so that hurt the company's profits. And then it was reinstituted in 2018, retroactive for 2017, and it boosted their net profit something like to 237 million for 2018.
The last thing I'd kind of want to probe in a little bit deeper is it seems like they're doing, I want to look into what they're doing with their debt in a little more detail, because just by the data you've given us, it doesn't look like their overall liabilities seem to be growing.
Right.
But there's this shift from long-term debt to current liabilities, and I just want to understand that better. So I want to see just what they're, first of all, their credit rating, second of all, just how they're talking about their long-term debt. It sounds like they're planning on issuing more, and then did you do a free cash flow to the firm as well?
I did, and that delivered a very high price. It was something on the like $367. That was probably close
Okay,
to not be accurate and reflect the price of the company. So I also may have gotten which one accounts for debt better flipped.
yeah,
So.
I think you put the notice, so.
I would have weighted that one much.
And then
less.
this chart you show us,
They have, so the orange line in this one is the S&P 500. The green line in this one, which are almost exactly the same line, is the Energy Select Spider. And so they have outperformed both of them, showing over 140% growth in the last year in appreciation of their stock price.
okay, if we went back more than a year,
It still continues to go up. It's never really, they've had a high point and then they dipped. It's almost always been consistent growth, though there have been temporary downturns. As we can see here, around July, it's sort of the middle, there was a little dip there. And then also towards the end of the year, last year.
okay. Questions from the class?
Well, two things. So, your target price, it says it's like $156.
It does.
Although when it on the and then on the target price thing, when you actually weighted them, you didn't put the weight on them. You just kind of added them together. So when you put the weights that you put there, you come up with a target price of
Oh,
$71.
no, those are the pre-weighted ones. So that is 30% of what the
Oh, okay.
FCFE was.
I think his point is that you have a FCFE of 95 and a relative valuation of 61 and somehow come up with an average of 160.
No, yeah, I see what you did now.
Yeah.
So
You,
I had weighted, those are
Okay.
the already weighted.
Yeah.
Okay.
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 I don't
So-
want to clutter it up too much.
is that about
So how do you-
400% return? Given your target price?
Roughly, yes.
Jeez. The other thing is on your valuation assumptions.
Mhm.
So if you look at their tax rates are like relatively low, between 1 to 8%, because I imagine they get a bunch of tax breaks for just being renewable in general. But for your valuation, you put a tax rate of 21%, which is much closer to the corporate one.
Yes.
So is that like more of a long-term one that'll kind of even out to that, even with any kind of like renewable tax breaks?
Yes. That is more of a long-term one, mainly because I expect them to continue posting positives, and so they will have to pay the tax rate. And they didn't list in their 10Ks what their effective tax rate was. Bloomberg had it as something, I believe it was 8% for 2017. So,
Mhm.
What you're probably seeing is a lot of like loss carry forwards since they've had a few negative earnings years.
right.
I don't imagine any sort of renewable tax credit schemes is that would be, well, you wouldn't see it reflected in that way.
No. And in general, most tax credits are something on the order of, the largest one is 20 cents, and that's in Texas, and that just means you don't pay the extra diesel state tax. But most of them are on the order of around 6 cents a gallon, and those are from the states individually.
Just real quick, can I go? It also says the change in number of shares is gonna increase by 16%. Is that because they're gonna issue new shares?
They do not have a plan to issue new shares. Right now, that's just a hard change. They're instituting a repurchase program right now.
So that would be a reduction in the number of shares, not a increase, right?
Yes.
Okay.
Where are you seeing that number, Peter?
On the valuation assumptions on the second page?
It's plugged in as a negative on the
Okay,
valuation.
okay, so just, yeah, it looks
It looks
positive
like a
here,
typo
so.
there.
Okay.
Oh, so I was wondering about the target price. Why did you weigh the relative valuation for PE 70%? Why did you use PE for the relative valuation?
Well, I weighted at that because I wanted to see how they were doing to their competitors, and I believe that they're, generally, the energy sector kind of moves, the group of companies will move together, and I selected the companies that were mentioned in here, Valero, Nestle, Cosin, I believe. But I weighted it off of those, and it showed they're all gonna move together because they're all generating the same amount of revenue from renewables. And so if something were to regulatory affect one, it would hit all of them about the same.
So you have, say, Valero in here, which does a lot of conventional fuels as well.
Yes.
So,
I tried to segment out and just get the renewable portion, avoid that question, and that issue with it, but they did not
well,
deliver.
for the purpose of taking like a relative valuation, it's not like you can take a PE for just their
Right.
renewable segment. So maybe one place that would be interesting to look, even if there's some companies that maybe aren't perfectly comparable, but maybe a few companies that compete in renewables specifically, look at how they're trading, look at their PE and movement of their stocks relative to like diversified oil and gas, to just see if they move in lockstep, if everything just moves with energy prices, or if one kind of acts as a hedge to the other.
Okay.
Okay?
I just didn't think that the PE was an accurate measurement because I don't know, like one of the PE says it's 74. I don't know how you got that.
That is the ethanol producer Green Plains. They're starting to enter this market, and so I think that's just, that was the snapshot one.
Oh, okay.
Oh no, sorry, that was the last year's. Yeah, people just think they're gonna grow really fast. I don't think they're gonna grow that fast, personally. But they could be a major competitor if they decide to enter the market in some size.
It also says I had a negative EPS, so I don't know how the PE was so high.
Yeah.
Is the US's consumption of biodiesel projected to grow more over the next 5 years, or is it stalled?
I think looking at the historical track record, it's going to continue growing. There are several cities, specifically Chicago, New York, and San Francisco were all listed as major buyers. So the New York City Parks and Rec Department entirely runs off of their fuels.
Oh,
The
wow.
entire city of San Francisco's entire fleet of vehicles runs off of their fuels, and specifically this company. And then the city of Chicago uses their maintenance vehicles, so anything that like would cut the municipal parks, like the lawnmowers, tractors, and then also all their garbage trucks, they switched to this. And that's all been in the last 2 years.
Oh, that's really cool.
So,
Um,
to Jay's point, I do think maybe running this valuation, the relative valuation again, taking Green Plains out,
Okay.
might provide will certainly provide a lower number, but still probably an attractive looking number, just looking at this math, but I would be taking out a
Take it
company
out
with negative EPS, right? Because I'm assuming what happens, why you get a high PE ratio like that, so obviously it's not for the same time period, because if it was the same time period, the PE ratio and the EPS, then the PE ratio would also be negative, does that make sense?
So I just assumed that he maybe like did an absolute value, which you shouldn't do.
I don't think he did an absolute
He
value,
didn't,
my guess
okay.
is this, they're from 2 different time periods,
Okay.
is more likely.
That makes more
Yeah.
sense.
But what happens is if maybe they had positive earnings, but a relatively small number for positive earnings, then it inflates their PE
Yeah.
ratio. So that's why their PE ratio looks kind of high.
Yeah.
Okay. Okay, guys.